Have you noticed that gold is making headlines again? For years, many investors focused on stocks, technology companies, cryptocurrencies, and real estate. But in 2026, something interesting is happening. More investors, institutions, and even central banks around the world are increasing their exposure to gold. So, what's driving this renewed interest? Is gold really a smart investment in today's economy? Or are investors making the same mistakes we've seen before? In this video, we're breaking down why gold is attracting attention again, the biggest myths surrounding gold investing, and whether it deserves a place in your portfolio. Let's get started. Gold has always held a unique position in the financial world. Unlike stocks, gold doesn't represent ownership in a company. Unlike bonds, it doesn't pay interest. Unlike real estate, it doesn't generate rental income. Yet for thousands of years, people have considered gold a store of value. The reason is simple. Gold is scarce, durable, globally recognized, and cannot be created out of thin air like paper currency. When uncertainty rises, investors often look for assets they believe can preserve wealth. That's where gold enters the conversation. One major reason investors are paying attention to gold in 2026 is inflation concerns. Even though inflation may not be at its highest levels anymore, many Americans are still dealing with elevated prices for housing, groceries, healthcare, and insurance. When purchasing power declines, investors look for assets that can potentially protect wealth over the long term. Historically, gold has often been viewed as an inflation hedge. While it doesn't always move perfectly with inflation, it has frequently maintained value during periods when currencies lose purchasing power. Another factor is economic uncertainty. Markets dislike uncertainty. Whether it's concerns about government debt, geopolitical tensions, slowing economic growth, banking risks, or recession fears, uncertainty often pushes investors toward defensive assets. Gold has traditionally benefited during periods of fear and instability. That's because investors are not necessarily buying gold for growth. They're buying it for protection. Think of gold as financial insurance rather than a growth engine. And that brings us to one of the biggest misconceptions about gold. Many people believe gold is supposed to make them rich. Historically, that's not really the primary purpose of gold. Stocks have generally outperformed gold over very long periods because businesses create earnings, innovation, and economic growth. Gold's strength is different. Its primary role is wealth preservation during difficult periods. That's why many financial professionals recommend viewing gold as part of a diversified portfolio rather than a replacement for stocks. Now let's talk about central banks. One trend that many retail investors overlook is the growing interest in gold among central banks around the world. When central banks increase their gold reserves, it sends a message. These institutions often seek diversification away from excessive reliance on any single currency. Their actions can influence long-term demand for gold and contribute to positive sentiment in the market. But before you rush out and buy gold, there are several important things you need to understand. First, gold is not risk-free. Many people assume gold always goes up during economic crises. That's simply not true. Gold prices can be volatile. There have been periods where gold experienced significant declines and remained flat for years. If you're expecting guaranteed gains, gold may disappoint you. Second, timing matters. Buying gold after a major price surge can expose investors to pullbacks. Like any asset, gold moves in cycles. Fear and excitement often drive prices higher than fundamentals justify. That's why disciplined investing is so important. Third, understand the different ways to invest in gold. Physical gold is the most traditional option. This includes coins and bullion. The advantage is direct ownership. The disadvantage is storage, security, and insurance costs. Another option is gold exchange-traded funds, commonly known as ETFs. These allow investors to gain exposure to gold prices without storing physical metal. Many investors prefer ETFs because they are easier to buy and sell. There are also gold mining stocks. These companies produce and sell gold, but their performance depends on much more than gold prices alone. Management decisions, production costs, operational risks, and market conditions all play a role. As a result, mining stocks can be far more volatile than gold itself. So, how much gold should investors own? There's no universal answer. Many experts suggest keeping a modest allocation rather than placing all your money into a single asset. Diversification remains one of the most effective ways to manage risk. A balanced portfolio may include stocks, bonds, cash reserves, real estate, and potentially a small allocation to precious metals such as gold. The key is understanding why you own it. If you're buying gold because you believe it will double overnight, you may be setting yourself up for disappointment. If you're buying gold as a long-term hedge against uncertainty and currency risk, your expectations may be more realistic. Looking ahead, gold will likely remain an important asset in global financial markets. Economic cycles come and go. Inflation rises and falls. Markets experience periods of optimism and fear. Through it all, gold continues to play a role as a store of value and a diversification tool. The biggest mistake investors make is treating gold as an all-or-nothing decision. You don't have to be 100% invested in gold or completely avoid it. Smart investing is about balance. It's about understanding the strengths and weaknesses of every asset class. And in today's uncertain economic environment, that's exactly why gold is back in the spotlight. So here's the question for you. Do you currently own gold, or are you considering adding it to your investment strategy? Let us know in the comments below. If you found this video helpful, be sure to like, subscribe, and turn on notifications so you never miss our latest videos on investing, wealth building, personal finance, and the US economy. Thanks for watching, and we'll see you in the next video.